As the world braces for the economic turbulence that President-elect Donald Trump's proposed tariffs may bring, bankers in Hong Kong and Singapore are preparing for a whirlwind of activity. For months, these financial hubs have been bustling with a surge of shipments from Asian exporters racing to beat the clock before import taxes kick in. But what happens when the tariffs take effect and the trade tide recedes? For the region's banks, the answer may lie in a surprising place: the ultra-wealthy. Asian banks, particularly heavyweights like HSBC Holdings, Standard Chartered, and DBS Group, have long relied on the lifeblood of cross-border commerce. HSBC alone facilitated $850 billion worth of trade in 2023, and Standard Chartered generated nearly $7 billion in revenue from corporate and institutional banking. Trade has been the engine powering these institutions, driving loan growth and business expansion across the region. However, Trump's proposed tariffs, ranging from 10% to 20% on all foreign goods, and even steeper rates of up to 60% for Chinese products, threaten to grind this engine to a halt. With 8 of the United States' top 15 trade deficit partners hailing from Asia, the region is squarely in the crosshairs of these new policies. Anxiety is palpable. Economists warn of ripple effects that could slow domestic demand and mortgage lending, further denting banking revenues. Despite these challenges, the outlook for Asian banks isn't entirely bleak. For one, they could price loans at higher premiums, offsetting some of the lost trade financing. Trump's policies, including tax cuts and tariffs, are expected to spur inflation, potentially limiting the Federal Reserve's ability to cut interest rates further. This could stabilize margins in Hong Kong's banking market, providing a silver lining amid the uncertainty. But mere survival isn't enough. To thrive in this new reality, banks must pivot beyond traditional revenue streams like trade finance. Wealth management and capital markets are emerging as critical battlegrounds for the future. In 2016, Asia's top 15 private banks managed $1.3 trillion in assets. Today, that figure has nearly doubled, and analysts project similar growth through the end of the decade. As global investors increasingly view Asia-Pacific as a safe haven, Hong Kong and Singapore are positioning themselves as wealth management powerhouses. Both cities have implemented tax-friendly policies to attract family offices, the private entities that manage the wealth of ultra-high net worth individuals. Each now oversees $1.3 trillion in offshore assets, second only to Switzerland. Asian billionaires, particularly in China, India, and Indonesia, are leading this charge. Over the next decade, trillions of dollars will transfer from one generation of tycoons to the next, creating enormous opportunities for banks to offer estate planning, asset management, and investment services. The momentum isn't confined to Asia. Wealth is flowing from Europe and North America as global investors seek portfolio diversification. Bank of Singapore, for instance, is actively courting affluent clients in the UK, where rising taxes under a Labour government are driving wealthy individuals to explore offshore options. Yet, this burgeoning wealth comes with its own challenges. Not all wealthy clients are created equal. Some prefer passive strategies, trading rarely and resisting high fees, behaviour that can erode margins for banks. Asian financial institutions must tread carefully, selecting clients whose financial needs align with their own profitability goals. As Asian banks navigate this evolving landscape, they must also keep a close eye on US tax policy. The Republican victory in retaining control of the Senate has stymied Democratic efforts to overhaul Trump's 2017 tax cuts, which are set to expire next year. For now, wealthy individuals in the US and abroad can continue to benefit from a favorable tax environment, fueling their appetite for unconventional investments. Take Bitcoin, for example. The cryptocurrency's meteoric rise, recently nearing $95,000, illustrates the growing interest in alternative assets. Banks in Hong Kong and Singapore are capitalizing on this trend, expanding their offerings to include digital asset management for their affluent clients. As trade slows, the wheels of wealth creation are spinning faster than ever. The story of Asian banks in the face of Trump's tariffs is one of resilience and reinvention. While the tariffs may disrupt the flow of goods, they are unlikely to derail the region's financial institutions. By tapping into the growing pool of wealth in Asia and beyond, banks are charting a new course, one that prioritizes wealth management, capital markets, and innovative financial services. In a world where trade is increasingly riddled with friction, the ability to adapt is key. For Asian banks, the pivot from trade to wealth marks not just a survival strategy, but a blueprint for thriving in an era of uncertainty. As they embrace this transformation, one thing is clear: the future of banking in Asia is as dynamic as the region itself.